Want to invest in one of the world's biggest and best businesses? Like the idea of buying a stock after it's dropped 20%? Looking for a market-beating yield and inflation-beating dividend growth? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing high value and necessary defense products and services. Sovereign defense has been necessary since, well, sovereign entities have existed. That's because human conflict is unfortunately present whenever humans are around. And we've moved a long way from bows and arrows. Defense products and services nowadays are extremely complex and expensive. And that means plenty of profits and dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a totally free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Lockheed Martin Corporation, which appear to be trading at a significant discount today. Lockheed Martin Corporation, stock ticker LMT, is the world's largest defense contractor. Founded in 1912, Lockheed Martin is now a $92 billion by market cap global defense monstrosity that employs over 100,000 people. The company reports results across 4 segments: Aeronautics, 40% of fiscal year 2020 revenue; Rotary and Mission Systems, 25%; Space Systems, 18%; Missiles and Fire Control, 17%. The U.S. Department of Defense accounts for approximately 65% of revenue. Nearly 25% of revenue is international. The remaining 10% comes from various U.S. government agencies. Commercial sales are immaterial. The company manufactures a range of major military aircraft, including the F-35 Lightning II, the F-22 Raptor, the F-16 Fighting Falcon, and the SH-60 Seahawk. The F-35, a 5th-generation combat aircraft, is the largest and most expensive military weapon system in the world. In addition, their various missile programs are critical for both offensive and defensive capabilities. Look, sovereign defense has been necessary for as long as there have been sovereign entities. It was true when we were using arrows, it's still true now that we're using missiles. And that'll likely remain true until the end of time. Major defense contractors are practically guaranteed ongoing sales for a time period that stretches beyond my lifetime. What's particularly great about Lockheed Martin specifically is that it is the world's largest defense contractor, headquartered in the world's largest spender on defense products and services. Morningstar sums it up really well, and I'll quote here. In our view, Lockheed Martin is the highest quality defense prime contractor due to its prime position on highly prioritized programs, particularly the F-35, and the company's portfolio positioning toward areas of secular spending growth, especially missile-related and space technologies. This combination of scale, positioning, and quality is highly unique and advantageous. And because of the way in which weapons programs continuously advance in terms of scale, technology, and cost, major defense contractors benefit from this progression layered onto built-in demand. And I think that sets up Lockheed Martin to grow its revenue, profit, and dividend for many decades to come. As it sits, the company has already increased its dividend for 19 consecutive years. In fact, they just increased their dividend yet again in late September by nearly 8%. That's not terribly far off from the 5-year dividend growth rate of 9.8%. The stock also yields 3.4%. That yield, by the way, is 80 basis points higher than its own 5-year average. It's a very appealing combination of yield and growth. The payout ratio is a moderate 51.6%, easily covering the dividend. I see the sweet spot for dividend growth stocks to be a yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. This stock is in that spot in the sweetest possible way. Looking at business growth, Lockheed Martin has increased its revenue from $46.499 billion in fiscal year 2011 to $65.398 billion in fiscal year 2020. That's a compound annual growth rate of 3.9%. I like to see a mid-single-digit top-line growth rate from a mature business like this one, and Lockheed Martin is basically there. Meantime, earnings per share increased from $7.81 to $24.30 over this period, which is a compound annual growth rate of 13.4%. That's fantastic. The company has steadily expanded margins and bought back stock, which helped to propel the excess bottom line growth here. For perspective, the outstanding share count is down by about 17% over the last decade. Looking forward, CFRA anticipates that Lockheed Martin will compound its earnings per share at an annual rate of 7% over the next 3 years. The risk of the U.S. Department of Defense spending cuts hangs over Lockheed Martin like the sword of Damocles. It's been that way since I started investing in 2010. It's still that way today. CFRA believes the risk is overblown. They state, and I quote, "However, we see this risk mitigated by Lockheed Martin's focus on DoD's high-priority advanced technology programs, which are likely to avoid cuts even if total defense spending is reduced, in our view." The market apparently sees this risk as heightened with Democrats in power, which has undercut the stock throughout 2021. It's down year to date. I'd argue the market is getting it wrong, discounting the stock for no good reason. CFRA would seem to agree on this, adding this, and I quote, "This steep discount is driven by market fear of defense spending cuts under Democrats, in our view, but in fact, the Democrat-controlled Senate Armed Services Committee has already passed a 5% defense budget increase over the Trump-era level with overwhelming bipartisan support." All that said, much of this is missing the point. The point is, Lockheed Martin doesn't necessarily need much defense spending growth in order to grow their business at an acceptable rate. Besides, the company has a backlog of nearly $135 billion to work through. CFRA's adds granularity to this point. Further, defense budget growth is not critical for Lockheed Martin, as it grew earnings per share 10% annually during 2012 to 2015, even as defense spending fell 4% annually in those years. The stock did fall somewhat dramatically after a so-so Q3 report that missed revenue expectations. Still, the company grew adjusted earnings per share by 11% year over year. In the end, I see nothing to indicate that Lockheed Martin can't or won't continue to increase the dividend at a high single-digit rate for the foreseeable future. Combining that level of dividend growth with the 3% plus starting yield offers a great total package, in my opinion. Moving over to the balance sheet, the company maintains a very solid financial position. Long-term debt-to-equity ratio at 1.9 is a bit high. That's mostly because of low common equity, not a large debt load. The interest coverage ratio of over 15 is great and reveals no issues at all with servicing debt. Profitability is robust and improving. Margins have been expanding nicely, although low common equity has juiced ROE. Over the last 5 years, the firm has averaged annual net margin of 9% and annual return on equity of 303.6%. I find very little to fault about this business. It's fundamentally excellent, the backlog is huge, their industry is an oligopoly, and it provides a necessary suite of products and services to very willing buyers with near unlimited purchasing power. And the company benefits from durable competitive advantages that include global scale, material barriers to entry, long-term contracts, unique government relationships, and technological know-how. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. A global oligopoly does limit competition. On the other hand, direct government relationships can lead to more regulatory risk. The very business model presents geopolitical risks. Product execution has been a recent risk. For instance, they've had cost overruns with their F-35 program. Any pressure on government spending, which would put pressure on DoD spending, could reduce revenue and profits. I view these risks as tolerable, and with the stock 22% off of its 52-week high, I think the valuation is very appealing right now. Shares are trading hands for a price-to-earnings ratio of 15.1. That's below the broader market by a good margin. It's also substantially lower than its own 5-year average price-to-earnings ratio of 22.4. There's also the matter of the price-to-cash flow ratio of 13.5 being well off of its own 5-year average of 17.3. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth growth rate is on the higher end of what I typically allow for. If there's a business that deserves it, it's this one. Keep in mind, the dividend growth rate I'm accounting for here is well below the company's long-term proven growth across both earnings per share and the dividend. It's also lower than where their most recent dividend increase, announced only months ago, came in at. With the payout ratio being moderate and CFRA expecting high single-digit earnings per share growth over the next few years, I see this as a very achievable number for Lockheed Martin. The dividend discount model analysis gives me a fair value of $481.60. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Lockheed Martin as a 4-star stock with a fair value estimate of $402. CFRA rates Lockheed Martin as a 5-star strong buy with a 12-month target price of $463. I came out slightly high. Averaging the three numbers out gives us a final valuation of $448.87, which would indicate the stock is possibly 38% undervalued. Here's the bottom line, guys. Lockheed Martin Corporation is a high-quality business across the board. They provide necessary products and services within the framework of a global oligopoly, all but guaranteeing plenty of future growth. With a 3% plus yield, high single-digit dividend growth, nearly 20 consecutive years of dividend increases, a moderate payout ratio, and the potential that shares are 38% undervalued, this is one of my best long-term ideas for dividend growth investors. And now for a special news announcement. Albemarle Corporation, stock ticker ALB, just reported a strong Q3 report that saw them beat on both the top and bottom line. Fiscal year 2021 guidance is calling for adjusted earnings per share that's well above consensus expectations. I've covered the stock a number of times on the channel, such as the video I put out only a month ago when I called it among the best dividend growth stocks out there. This has been a great play on EV growth because of its lithium exposure. It's not cheap, but you could have said the same thing when it was half its current price. If you don't already have this dividend aristocrat in your portfolio, take a good look at it. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.